Hi Raman, this is Sachin and Jigar. You let me know whenever we are ready.
Yes, Shikhar bhai, thank you.
Hmm.
I think we are ready. We have the audience, and some of the leaders will join in. We can begin the call. So, thank you, everyone. Thank you for joining in. I'm very excited to host this call. To welcome Sachin bhai and Jigar bhai from SVAN Investments, who are part. We've been engaging for last almost I think 1.5 to 2 years now. We brought the PMS offering on our product portfolio offering, and now we are excited to share that they have got a license for the category 3 AIF, which means, some of you would be aware, just to refresh everyone's memory, we said that for a PMS, the minimum ticket was 5 crores, and we wanted an offering which can give our clients access with Swan Investment at 1 crore tickets. And that's where the category 3 AIF, which is now being launched, is available. What I would request is, Jigar Bhai and Sachin, because there will be some people who joined newly, might not have spoken to you guys last time when we did the call. If you can introduce yourself, talk about Swan, and then talk about the product offering, and then take it forward. And whenever you need the presentation, let us know. Would you be sharing it, or I can have Kanish share the presentation so that audience can also see it now?
Thanks Raman, thanks everybody to join in. So before we start, I'll just give you some brief about Swan and then we'll let Sachin talk about himself and then I'll talk about myself. So Swan was started by Sachin in 2019 as an informal advisory for some of the corporates and ultra HNI. And he has been managing that money from 2019. Then 2021, I joined him as a co-founder and a partner, and we established a LLP. And in 23, we got our PMS license. And from there, we have been now managing around 2,500 crore rupees on a listed equity side on the PMS side. And now, obviously, we have launched our AIF, which we'll discuss that in detail. But before that, I'll ask just Sachin to give a brief about himself, and then we'll. So before Sachin starts, so and I think tell Raman because we don't know he can if we can also current the presentation. Yeah. Meantime, Kanish, I would request if you just can put the presentation on. So we'll just have a flow there. So I started my career in 2000 in equities. I was with Motilal Oswal for 16 years in different roles. And post that for 5 years, I was co-head active equities in a boutique PMS house called Quest Investment Advisors. And then obviously 21 or so we started or we took this journey forward of SVAN LLP. So that's a little bit about myself, and I'll ask Sachin to now brief about himself.
Yeah, hi. Good morning, folks. Thank you for taking the time out and doing this call with us. Uh, just to give a brief background about myself, I started my career in 2000 as an equity research analyst. So my entire career has been on equity research and investment side. I worked on the sell side for close to around 8 to 9 years. Uh, in 2009, I changed my career profile and I moved from the sell side to the buy side. And I joined the office of Mr. Ashish Kacholia, an investor most of you would recognize the name with. I was with Ashish for close to around 11 years. I was the senior most member of the team. And from there, during that journey, when I joined the AUM, were close to around 400 crores and saw the organic journey to close to around $1 billion from there until 2019. 2019 is when I wanted to start my entrepreneurial journey. I was already managing some money as per my discussion with Mr. Ashish for the last 3 4 years before I left it. And I told him that I wanted to, since I was quite happy or I was quite, I would say, optimistic and excited about doing this a full-time philosophy, full-time job. I told Mr. Ashish that I would want to start on my own, and that's why in 2019 I moved from Lucky Investments and started Swan Investments. Jigar is somebody I've known for close to around 20 years, since 2004. And as I realized that it's a combination of one managing money, but when you're managing AMC, you need a lot of experience in terms of managing the clients as well as managing the operations, for which I had no experience. And Jigar had always, headed the HNI in the family office at Motilal Oswal. Plus, he was part of the senior leadership team at PMS for the last 3 years. So we discussed that in 2021, he joined me as a partner. 2000, then that's when we started to apply for the formal structure. And 2023 is when we got our license to start the PMS. Initially, most of the money that we raised was basically from people that I have known, which are mainly corporates and family offices. And as our ticket size was fairly large. And plus, we were also initially looking to build first the research team in some track record. before we go into the market, and hence we had kept a larger ticket size on the PMS side. Around 1.5 years back is when I started to engage with Rahul, and we obviously we are officially on board as a PMS side. But the feedback that we keep getting from some of the members of the team and Rahul was that being new to the market, some of your clients probably wanted to start with a lower ticket size, and then we wanted to have a different product for that. So we thought that we will launch this AIF, which will serve us two purposes. One is that the PMS doesn't allow me to participate as a QIP in terms of a pre-IPO or anchor client, and also not in terms of preferential allotment, which I can do in an AIF. So that was the other thing that we thought is this structure will bring in, because obviously it helps me offer a lower ticket size product. So that's the very brief about it, and maybe we can take it from here. Raman, you suggest how we want to take it from here. People want to see the presentation, and people will have some questions. We are open with anything.
So if you can just brief us about, what is the uniqueness when we go to our clients to talk about, how is SVAN as a house different than a lot of offerings available in the market. So if you can talk about a little bit about the philosophy, of your investing, and any specific focus areas where you'll be focusing as part of the pitch, which we will be supposed to doing on the AI side of it. I think that will help the team.
Guys, in brief, what we do, I'll just try and explain, and then probably Sachin can add in when he wants to. We are bottoms up, detailed, in-depth research house. We typically invest on our own ideation with our own projections, and we do extremely in-depth research. And we have one of the largest teams. We have a 16-member research team. Apart from that, Sachin and myself also gives larger part of our time to research. So it's a research house. Let's put it this way. First of all, we typically focus on mid and small. It doesn't mean that we don't look at large cap opportunities, but typically we chase returns. And for that, we think that sweet spot is anywhere between 4,000 crore to 20,000 rupees, where we get our largest kind of opportunity for our kind of return expectation. So we are bottoms up. We focus on mid cap and small cap with very, very long-term orientation. Our average holding period is anywhere between 3.5 years time. So it's a low churn product. And maybe, anything else you think? These are the 3-4 things we typically focus. And one more thing. Typically, the kind of holdings you will see in our portfolio, you'll not see at a lot of places. So probably that is also one uniqueness we bring on the table, because of our research capabilities and our in-depth understanding. We probably is able to identify some of the stocks very, very early in the cycle. So that differentiation one can see when one will compare our portfolio with others, apart from the return and everything else.
Basically, long-term orientation in terms of approach, we try to find ideas where there's probably, we feel that on a long-term basis, there's mismatch in terms of what the market is pricing in versus what is the value in the stock from a 3 to 5 year perspective. And as Jigar mentioned, since research is our backbone, he already mentioned that we have 15-member research team, of which 5 of them are with more than 15 years of experience. Typically, we spend a lot of time before buying a company, and sometimes it could be as long as 1.5 to 2 years before we end up, buying a company. We keep meeting them, and there are many companies where we invested. We would have met the management 4 to 5 times. We would have done 2-3 plant visits. We may have done a lot of channel checks, and that's when we, after that only we end up buying. So that's probably a very brief about the thesis and the investment philosophy. And we are happy to take.
As far as portfolio construct is concerned, any given point of time, we'll have on an average 35 to 40 stocks. That works brilliantly in terms of managing the risk. At the same time, also creates very decent amount of funnel for us to build more position in the one stock where we already entered. So at any given point of time, our risk is well spread out, and at the same time, we have a decent amount of funnel to build up the position.
Any examples, Sachin bhai, Jigar bhai, you want to, whatever there is in the presentation, just for the, everybody to understand and explain it to the client perspective?
Sure. I would rather ask Sachin to just give his brief understanding about V2 and how he has actually played out the whole story from 50 rupees to 2,000 rupees.
So V2 Retail is a company that I first met in 2018. I in fact started interacting with them in 2017. 2018 is when I built up a small position. We all know about the success story of Zudio. That is exactly what the vision of Mr. Ram Agarwal, who is the founder of V2, also had. But his target segment was maybe 1 to 2 notch lower than Zudio. So while Zudio operates at, I think, around 600 to 650 average price point, yeah, they used to operate 250 to 300 rupees price point. Which was basically to offer great value to price sensitive consumers and thereby take a leadership in the market. Unfortunately, a lot of things did not play out as anticipated, and there was a delay in terms of their overall strategy. In between, we all know that COVID struck in, and this being the bottom of the pyramid was the worst hit. So the entire thing got delayed by close to around 3.5 to 4 years. But we kept on engaging with the management, and we held on to our position. The good thing is that we did not have a very large position to begin with. And post around 12-15 months from COVID is when we started to get a sense that, COVID is more or less done. And the strategies that they had thought about are now starting to play out. So that is when we started building our larger position, which was in a price range of between, say, 90 to 200 rupees. And, so by that time, we had almost spent like 3.5, 4 years with the management. So we probably knew, things are now getting in stream. What were the mistakes they had done, how they were getting sorted out. And then obviously after that, it has played very well. And obviously we made very good money out here.
So there will be multiple stories like that, but obviously for the time constraint, we have given some of the case studies also in our presentation. So that is how it is. So we typically sit through the cycle of 3 to 5 years and we'll see a multi-bagger coming out. So that is the typical approach. We aspire to or endeavor.
Yeah, so for example, Shada Motors again, something I bought in 2018, 17, 18, and still is parts to be our portfolio. As you see, a lot of the stocks which have been like, what we typically call a high compounder or a multi-baggers. Most of them, I would say 80% of them would be the ones which would have held for more than 4 or 5 years. And because we believe that's the minimum time frame that you require before you can, have a very strong compounding in a stock. Sometimes if you get the cycle accurate in terms of timing, then probably it happens for a little faster. Take the case, for example, something like a Shakti Pump. Ramesh was the previous one. So this was again a company that came to my radar in 2020-21, which is when this PM Kusum scheme was launched. But what we realized is that since it was tender-driven market, we needed to do more research. So we kept on meeting the management and we realized that, the tenders were getting delayed. There are a lot of issues out there. So we spent almost 2 years with the management before trying to figure out what exactly would be the right time this time. So maybe we are a little lucky also. We were able to get the timing right, close to when the I can say the scale up in Kusum scheme happened. And, this is one stock which we made like 7-8x, but in a period of 2.5 years. So I would say we are a little lucky out here. Same thing, spending 1.5, 2 years with the management, understanding the market, what are the challenges the market is facing, what is the opportunity size, seeing that, doing at least a couple of plants visits, checking with other people in the market in terms of the, the reference of the management, their intentions, what is their pedigree and all that, talking to some of their even suppliers. So this is typically the type of approach that we follow. The other thing which I want to share is that, which Jigar mentioned, is that we have close to anywhere between 35 to 40 stocks in our portfolio. We have done some our back testing and got it audited. I think in the last 7 years, I think 75 to 80% of them would have met the average IRR return of the fund.
Yes.
Which would mean that, which gives a lot of confidence that, this type of return that we are generating is more scientific approach. It's more scalable. It is more repeatable. Whereas, if the return is probably hinged on some 2 or 3 stocks where you had a larger allocation, then, while the overall IRR is fairly high, sometimes it becomes a challenge because then your hit ratio is not that good. So that's what we want to talk about.
And obviously our endeavor is to double our capital every 3.5 years time. So whatever clients money we have, typically our endeavor is to double that in 3.5 years time. Is the whole agenda of doing all this, in-depth research, keeping a lot of processes in place, continuously working on our proprietary valuation metrics and all. So Raman, if anything else.
So Jigar bhai, overall at SVAN level, what's the overall, investment corpus which we are managing right now as a fund, so that we know at the organization level, the total money which has been managed across PMS, AIF, as well as, the advisory business in total?
So as AIF is just started, right? So
Correct.
PMS plus advisory on a SEBI reporting basis is around 1,400 crore rupees. Otherwise, we typically manage 2,500 crore rupees because of some technical reasons, which we'll discuss. But you can assume 1,400 crore rupees is what is right now printed on our SEBI site.
Fair. So we should communicate that number only, while I'm saying.
Yeah.
So just to quickly introduce the, the category 3 AI, which is there. So the strategy more or less remains similar to the PMS strategy with some additional stuff which you will be able to do in this strategy, correct?
Yes.
Yeah. So AIF is nothing but our same investment philosophy, same strategy. So 75 to 80% will remain common with our PMS. Some stocks may differ here and there, but otherwise the investment philosophy, the expectation and orientation remains the same. Now, only thing advantage we get on the AIF platform is that we can invest into unlisted, pre-IPO and preferential. So we intend to do anywhere between 15 to 25%, and that particular thing, like, which includes in unlisted, pre-IPO and preferential. But again, the investment philosophy, the thesis, the research filters will remain more or less same.
Time horizon,
everything remains. Number of stocks, everything remains the same. So for simplicity, one should only under any difference is in PMS, it is out and out listed space. Unlisted, we have a liberty and opportunity to anywhere between 15 to 25% of all this particular thing, like unlisted, preferential and pre-IPO. Otherwise, it remains the same. Even fee structure is same. Yeah, and from the distribution perspective, the ticket size of PMS is 5 CR, ticket size of AIF is 1 CR, and some of the other features, it's open-ended AIF with fortnightly inflows and monthly exits, with the open-ended but with the exit loads. So that is how when we appreciate if the communication to the client is also very clear that if somebody wants to invest, if the time horizon is nothing less than 3 years, then please don't do it. We typically expect money to be
thinking long-term money only.
Yeah.
I think that's a fair expectation. And if you can also talk about the fee structure which is available for the investor.
So up to 10 crore rupees of inflow from one client, the fee structure is 1.5% fixed fee, 12% flat hurdle on a CAGR basis, and 20% profit share over and above hurdle. So there is no catch up first, and the hurdle is also CAGR.
So just to give an example here, saying that say if my at the end of when I invest today and at the end of my anniversary date, after 1 year, my performance is 20%. So because it has cost 12%, whatever is the return above 12%, which is 8% in this example situation, you will charge 20% fees on 8% only. That's the correct understanding?
Yes,
absolutely. And one more important thing, after removing the fees, let's say NAV is 119, unlike other AIF, the next hurdle of 12% will get loaded on 119 and not on 112.
Perfect. That is what high watermark would mean, so that for the next year cycle.
High watermark is on the profit share. Hurdle logically, technically can be on the hurdle to hurdle. So you don't have to add hurdle on your higher watermark.
Got it.
But we are still doing it because we believe that is the right thing to do.
We would not like to name it, but yes, there are a few players in the market who obviously start the hurdle at 112 and not at 120 in this specific case that you're talking. So we are very clear. We just want to clear. In our case, it will be 120 and not 112.
Fair.
So the next 12% compounding will be on 120 and not on 112. That's the way it will.
Got it. Perfect. Just quickly to cover, if you can just also talk about some of the in terms of performance, in terms of where we are on PMS in the last. If you can just take us through the slide so that everybody understands it.
So as it is very clearly after a not so good year or probably rather little muted year this year, still our PMS, which started on 23 July, our CAGR after all the fees since inception is around 30%. And 2 years basis is around 27% on month, in the sense 2 years and since inception, which you can see. These numbers are after the fees, and that is CAGR. So it's not absolute, it's CAGR.
Okay. And team, for people who would have questions, my request is you should keep raising your hands, and I'll start allowing you to unmute and then ask questions with Sachin Bhai and Jigar Bhai once we complete the presentation. So there are some people who have Q&As, or you can put that in the chat box and I will take it at the end of the conversation. This is how the portfolio looks like from an allocation perspective, on sector-wise and market-wise.
As you would see, it's fairly well diversified. And as Jigar mentioned, the larger opportunity is less than $1 billion. So if you see 67% of the portfolio is
less than
10,000 crores, and the remaining 25 is between 10 to 40. Above 40 is only 3%. So, and you can see sector is also, it's fairly well diversified. It's not like one specific sector that we are particularly.
So Sachin bhai, it'd be fair to say it'll be more on mid cap, small cap, and micro cap focused kind of a strategy. Would that
Yes,
be fair
yes.
to communicate with the client?
Yes,
Absolutely,
yes,
absolutely.
As Jigar said, I think less than I think between $200-300 million to maybe $1.5-2 billion is the sweet spot, is where I think you should see larger part of the allocation happening.
At least 80% kind of AUM will go there.
And that's not like by, it's not that we start with that. That is where we end up normally. That's I'm saying from historical data is that the type of alpha that we look forward to, we typically end up investing like that. Obviously, if sometimes we end up having some great opportunity, maybe this above 40,000 crores, 3% could be 7% also. I'm not saying that, we have made us like a rigid rule, but that's how we see eventually the opportunities end up coming in.
We are market cap and sector agnostic, but we chase returns. Our endeavor is to generate superior alpha and superior absolute return.
Right. And Sachin bhai, what's your view on the market currently? I'm sure everybody would be interested to know, and that will be one of the questions which will come in. So might as well be the first one to ask that question for you. Where do you see the market from now till next 12 to 18 months period?
So I think the market post whatever has happened can be dissected into two parts. One is the inward looking, which is the sectors which probably have a lesser sensitivity to what is happening to the global markets, and second, sectors which have higher sensitivity to the global markets. If you see, obviously we all know what has been happening in the last, in fact, if you see since 2021, ever since the Ukraine war started, global macros have not been anything great. Global growth has been a challenge because of inflation, because of the geopolitical tensions. Something or other is happening, and hence we did not have like a clear rally in the global markets or the global macro in terms of what the way we had post-COVID. And obviously, last 4, 5, 6 months have become even more challenging. And now all we know that India probably has got also, actively entangled in all these things because of the geopolitical. Our belief is that as of now, till the time the clarity emerges, and we think that, probably we are getting very closer to getting this result, but we do not know what the final outcome would be. As of now, the stories which are more inwardly oriented, where the dependence on the global geopolitical is less, probably will do a little better in the short term. And the ones which are a little more export oriented is going to be a little bit more challenging in the short term. However, as we said, we believe that, companies where the managements are very strong. So, for example, the way we see it is that companies typically are what I would say a management or companies, I would bucket them into 3 categories. Category 1, 2, and 3. So category 3 are companies where obviously the managements have not done that great, or we do not believe those managements are great, and they have done a mediocre job of running the business. Typically, these are the companies which you only end up doing when there is a strong tailwind in the sector. Then there are category 2 managements which are very good at it, which are very good in terms of foreseeing what the risk that could come to their business, and probably they take corrective action. And most of the times they end up delivering numbers. The third category is the one, where we believe that the managements are very extraordinary. And obviously, when you are running businesses, there are 2 types of challenges that you could face. One is a challenge that probably you could foresee as a management or as a, in terms of running the business, which is something you can address forehand. But there are challenges like, for example, what happened in COVID, or for example, the way things have suddenly taken a U-turn post the change of political power at the US, which are not something that any management would have known 1.5 years back, and that's an unforeseen challenge. So great managements are the one, extraordinary the one which will also overcome these challenges. Yes, in the short term, there is going to be pain maybe for 2-3 quarters, because when you hit by such large unforeseen black swan event, it is very difficult for a company to come out of it in one day. But yes, over a period of 2-3 quarters, these managements are very smart. They figure out a way how to overcome those and again come back on the growth story. So that's the way I would like to put so. And we do have a mix of both. We do have stocks which are inwardly looking, and which obviously we are very positive that with the all the stimulus that has been given by the government, starting with the budget, followed by the RBI action of liquidity, and also in terms of the rate reduction and the current GST benefit that has been announced by the government, probably the story on the domestic consumption will start to pick up. And yes, we do have certain export-oriented stocks. These are extraordinary management that we have high degree of comfort because they have great pedigree. And we do believe that maybe in a couple of quarters, once there's more clarity, and these guys also get to know, because see, today the challenge for the management when you talk to them is also that they do not know what the final outcome is. So what is it that they should do to overcome it? So my sense is that maybe in 1 or 2 or 3 months at max, we will finally have what is the new setup that is there in the global order, what is the final tariffs we are talking about. And that is when we believe that maybe in a quarter or 1 or 2, some of these companies will start to have mitigation plans and we'll start to see growth coming back. That's the way I would probably summon your query and probably answer some of the other questions maybe that could come in.
Fair, absolutely fair. Thank you for sharing that. Just for the benefit of the group, if Jigar bhai, if you can just summarize the key USPs of the offering one more time before I open it for the Q&A. And for the benefit of the team, what we have done is we've done a comparison for both the PMS and AIF offerings, so that while you speak with the clients and prospective investors, you have clarity in terms of what is the difference between PMS offering and the AIF offering. So Jigar bhai, if you could just quickly sum up 5-6 key USPs of so that everybody can retain that part of it as part of the sales pitch.
So PMS vis-a-vis AIF?
So for the AIF perspective, what is the key USP, when I have to pitch the product?
First of all, we get opportunity to invest 15 to 20% or 25% into unlisted, pre-IPO and preferential, which is the biggest differentiation which we bring on the table as far as our Cat3 AIF is concerned. That is one. High focus on carry rather than the fixed fee. So we want to earn if client makes money. That is second. Thirdly, it is a differentiated mid and small portfolio allocation anywhere between 2,000 crore to 16,000-17,000 crore rupees. So for the benefit of everybody, I'll probably share our top 5 holding in PMS also, which is already which just comes in our this thing also SEBI reporting, and at the same time our fact sheet. So that one can also see the kind of stock differentiation which we bring on the table. Right.
And fair to add that the key one important difference which I heard was the strong research team which is available, which allows you to. I think that will be one of the key USPs we can add as part of the conversation.
Yes,
Annie, you may consider USP, we consider as a core. So
correct.
That's
correct. No, I think that's a very important part of it. It allows in terms of the in-depth coverage which is available for all these stocks. And that's a key that you have. You've invested in that strong research team.
Just to add one more data point, on an average, we end up doing more than 1,000 management meetings in a year.
Wow, that helps. Yep.
And some multiple times of that con calls and conferences and all that. Okay. So that is the kind of effort goes in.
Got it. So just quickly to cover,
our client interest is completely aligned with ours, in the sense Sachin's or my own personal portfolio is also absolutely aligned with what we buy for the clients.
Perfect. So there's clearly skin in the game, from the perspective of your money being part of it.
In the sense, whole body kind of stuff.
Got it. Perfect. So for the benefit of the team, there are two classes available for investment. Class A2 is less than 10 crores, and anybody looking at more than 10 crores will come into class B2. Fee structure as Jigar bhai said, 1.5% management fee for class A2, 12% hurdle, and a 20% performance fees, and that is without catch-up. So very important that that fees only above the hurdle rate is what is getting charged to the client as performance fees. There is no lock-in; it's an open-ended structure, but very important to understand there is an exit load. So we should look at getting this, whenever a client is looking at it, into mid-cap, small-cap, micro-cap kind of an investment, thesis. They should look at from a 3 to 5 year perspective horizon to look at it. There is an exit load, which we should be very clearly communicating to our investors, 3% for less than 12 months, 2% for 12 to 24, and 1% for 24 to 36 months. This is what is there for class A2, and similarly for class B2, which is above 10 crores category. It's available for everyone. From here, I think what I can do is I can open it for Q&A. I think Gautam has a question. Gautam, you may ask.
Before that, Raman, I just want to add one more thing. There is no setup cost. We are not charging anything upfront.
Correct. I get that. And there is an operating expenses, which is up to 1%
that is
of
up
actual.
To the maximum. That's fund accounting expenses and audit expense and all that, which is a normal standard one.
Fair.
And Nuama is our custodian, so
Yes. So again, important thing is that Nuvama is a custodian for SVAN investments. That is also equally comforting for us. Gautam, you may unmute and ask your question now.
Sachin and Jigar, I have one small query. Currently, let's say I'm a client who would be putting money now. So from the current portfolio, which are the 3-4 bets that you would help us explain to the client कि सर अभी के portfolio में ये 4-5 bets बहुत अच्छी लग रही हैं. Obviously, it's a 25 script का portfolio, but 4-5 strong conviction idea for 3-year point of view in the current portfolio. You can explain us.
So I can give you 3, 4, 5 names, but so to say, if we are buying, let's say 27 stocks, and if you are not convinced about those 27, why we'll buy it, right? So for us, all of them are same, but obviously we can probably differentiate on the basis of higher allocation we are giving to them.
So you can see the top 5 stocks is where the allocation right now is.
Exactly.
And that will tell you, if you want to understand why do a higher allocation in those stocks, something we can discuss that. Why
So a couple of ideas, Sachin bhai, you can explain now, because for example, on V2 ka story समझाया ना, so I think it's a past track record for a client. But in the top 5 stocks, if you can give me a couple of stories, it's easy to engage the client.
So there's another stock where we have high conviction. Is a company called Arvind Fashions. I think it's in the top 5, right?
Yes.
It's in the top 5 for us. So
Right.
Arvind Fashion is again a story that we invested a lot of time. And just to brief you, it's a company that is probably a play on the domestic consumption story. They went through a very difficult time. It was initially a part of the Arvind conglomerate, and then it housed the branded business of the Arvind Group. It was demerged, I think, somewhere in 1918-19, if I remember it exactly. That point of time, the philosophy was more top-line oriented, and they had many brands for which they had franchising, and they obviously got into a lot of balance sheet issues. After COVID, they realized that they had got into some issues, and there was also management change. And the new CEO coming in, the complete focus was first to improve the balance sheet, cut the number of brands, and then only focus on few brands and grow them profitably. That is when we started to have a look at the stock. Unfortunately, after we bought it, we all know that the domestic consumption probably became a little slow. So all the apparel companies had almost 4 to 6 seasons of slow moving, and hence the performance was not as to what we had expected. What we liked is that the management. So first of all, it's one of the reasons why we hold stocks for minimum 3, ideally 4 to 5 years is that, and we do not normally get wavered when there's a 10, 20, 30% underperformance correction, is that you should probably know why you are buying the stocks. So for example, we were very, very clear that why we were buying the stocks, because we could very clearly see that there are 5 brands on which they wanted to focus, of which 3 brands, which is Tommy, CK and US Polo, is where they had a great positioning and they had a great right to win. And also at that point of time, the larger peer, which is also listed, probably was more into the aggressive expansion mode, and they had a lot of brands that were getting assimilated, so they had a lot of other things to do, and they were focused somewhere else. So that was the whole thesis behind that, and now that has started to play out. If you see the overall performance of Arvind Fashion as a company in the last 3.5 years, one of the best in the apparel industry. The absolute numbers may not look that great because the industry itself was going through some sort of a weakness. We are hoping now that whatever has happened, the sentiments have changed. Last, in fact, quarter also, if you see, their growth rate started to pick up. What we understand, there's also again a leadership change. Our interest with the management tells us that now they want that the balance sheet is completely cleaned up. They're almost like zero debt. The focus is now on acceleration and margin expansion. So we believe that next 2 years it will again be. So it's been more than 2 years that we bought the stock. I think we would have bought in the range of say around 300, 320 is what we're buying. And today the price is some 520, 550. And it's been 2.5 years, and we see no reason, at least for the next 2.5 years, we should not continue to hold it.
Rather, we feel now the story is getting into actually the phase of catalyst, in the sense.
So yeah, acceleration is where we see that happening right now.
So between a Shoppers Stop and Trent, you still feel that they will do better in next 2-3 year cycle from your point of view?
But they have
no.
different business.
First of all, I think, Gautam, there's a bit of confusion. Arvind Fashion is a branded apparel company. They own the brand.
Achha, they are not into distribution. Understood.
Right. They do have some Coco stores of their own, but it's a brand story. It's
Understood.
like Page, right? For example, it's like a Page Industries. Whereas Trent and Shoppers Stop have a small portion of their revenue. They are mainly more of retailers rather than
brand.
Understood.
Trent is a mixture of both. They have the private labels on there. So Trent is more similar to V2, I would say. And Shoppers Stop is like a third-party branded model. And these guys are purely brand models where they do own some Coco stores.
Okay. And sir, one more question on this.
Sure.
Client might say that in India, the brand story have not played really well, except for a couple of exceptions. Let's say Manyavar, which was an exception. But most other players have not done well on the brand side.
I don't think so. I think that's not the fair perception then. If you see, for example,
Louis Philippe has done
and
brilliantly.
Louis Philippe has done brilliantly. Alan Solly, Van Heusen, and even if you see, for example, US Polo. US Polo is now more than it was launched in 2008-9, if I remember. On a big, it may have small presence, but I think the real presence started in 2009, and it's now more than a 2,000 crores brand.
Understood.
So Manyavar is, yes, I would agree that what has happened is that why Manyavar stands out is because ethnic as a category was extremely fragmented and unorganized, and that is where you had a brand coming in, and they obviously made a mark for themselves, and deservedly they have done a great job out of it. But otherwise, I think there are ample success stories in India in terms of brands which have done well. I don't think so. Okay, that's the right perception. And we have to also understand one thing, that is some of the brands that these guys own, they are in the mid to high. They are not into the economy of that. So that is one segment of story. We all read how prevention happening in India, how is the upper end of the market doing well.
Correct.
So the other thing that we like about them is that if you see a portfolio of brands, first thing is that, we believe that casualization as a trend in India is increasing. So within the apparel market, casualization has grown faster than the formalization, even if we adjust for the couple of periods of COVID.
Right.
The 5 brands that they have, Tommy, CK, US Polo, Arrow, and Flying Machine. 4 of the 5 brands are casual brands.
Understood.
In that also, if you see, the good part is that they have a Flying Machine, which you can maybe look at like a 1,000 to 1,500 rupee product. A US Polo, which starts from 1,500, 2,000, goes up to 3,500, 4,000, 5,000 rupees. Then they have Tommy Hilfiger from 4,500, 5,000 to 7,000, 9,000 rupees. Then Tommy, and then CK from 10,000, 15,000 rupees. So the good thing is that what we like is that the entire bouquet of range across 4 different brands, where we will position all 4 are reasonably strong. Flying Machine, I would say, is an average as of now, but there's a lot of focus that has gone in the last couple of years. But these 3 are very, very strong brands in their own respective categories. So they keep capturing, and as the consumer upgrades, they have an offering for the consumer at every level.
So they are part of the complete value chain of consumption basket, and they are extremely aspirational brands.
Understood, sir. Sir, एक story और बता दो, अगर 5 में से आपने एक बता दी, एक और ऐसे explain कर दो, because this helps us build better engagement with the client
Sure.
generate interest.
So I'll tell you maybe a couple of more examples. There is this company called Sharda Motors. Not many of you would have heard about it. So it's a company that got listed. It used to be listed on the Delhi Stock Exchange. It got listed on the Mumbai Stock Exchange under that mechanism of exchange somewhere, I think, around 2014-15, and that's when it started to come into my radar. Now this company basically, if you see, initially used to the main business was to make the exhaust component systems. Now if you remember, in 2020 there was a new regulation that came into India. So you have these norms in automobiles which are like Bharat stage 1, 2, 3, 4, 5, 6, right? So India was, if you remember, always behind the world standards in terms of the safety emission norms. And when the current political regime came in, they said that India needed to catch up with the emission norms globally, because this government is very conscious in terms of being much more focused on environment. And hence, normally what used to happen is that the upgradation used to happen one notch. Say Bharat 1, say Bharat 2, 2, say 3. Now 2016 is when the government mandated that this time will not go from 4 to 5, will go straight away go from 4 to 6. So obviously that would mean that exhaustion components are going to be very, very critical. So if you go and study this company, and that's when I started to have a look at it. When I read that, I said, let us see who companies could benefit. And that's when I started to figure out and realize this is one thing that makes those components. And when you saw the annual report, they are spending close to around 35 to 40 crores every year on R&D. Now that's very unusual for a company which is in the auto component space in India. India, auto component is more about manufacturing. So I could see that they were very well prepared. That's when we started to do channel checks. We went to the management, was that time also not that accessible. So we used to go to the AGMs, talk to them, read their reports, read their R&D spends. So when you talk about research, for example, one of the reasons why we were able to better Sharda Motors is that we used to spend a lot of time analyzing the entire R&D, because if you go to the annual report of India, there is a separate section on R&D itself that is given, right? So you analyze that, that's when we start to get a sense that, oh, they're spending 35, 40 crores. We also spoke to some of the OEMs, and they said that these guys are one of the smarter guys. They're putting a lot of focus. They put a lot of talent. So what happened is that when the transition happened, the number of players in the market reduced from 8 to 4. He could meet that challenge, and they probably being among one of those 4, one of the biggest beneficiaries. The balance sheet was robust. They had a lot of cash. If you remove the cash, since I would say it's not an auto component company, it's actually more of a technology company, because if you remove the cash and see the return on investment, it is in excess of 75-80%, which is what normally automobile companies operate between 18 to 20 to 23% of return on capital employed, return on investment, right? This company, if you remove the cash, which is giving you the strength of the business, the return on investment is in excess of 75-80%, because it's a technology oriented company. They continue to do so. Obviously, we all know that in between, yes, there was also some bit of underperformance because markets started to think that, the entire world is going to be EV dominated, and hence, this company will go out of business. There are 2-3 other levers that are happening in the company. One is the fact that the components that they make right now are not used in the construction equipment and the tractor industry. The new mandate that the government has come out with, there has been again, because the tractor industry has said that it will lead to cost escalation. There has been a delay of close to around, I would say, 18 months in that implementation, but we are hoping from 1st April 2023 it will get implemented. So that will open them another large market as big as what they have right now. Apart from that, the company has again kept on strengthening their R&D. If you see last 2-3 years also, they have recruited some very senior level R&D guys, including people who have worked with companies like Ashok Leyland at very senior level positions. And they have used the cash flows from the existing businesses to develop products which are agnostic to the ICE portfolio. So that is already now some 10-15% of the portfolio. Secondly, we all now know that the EVs, while they're going to be there, even yesterday I was reading a report that by 2030 in India, they are right now mainly into the passenger vehicle segment. I think we are looking at a figure of close to 14-15% on the EV portfolio on the car side, and not the sort of extinction that we are talking about. So that business will continue to grow. Apart from that, they just made some very big inroads on the export side. So again, on exports, they make big inroads. They also developed some very good components on the exhaust system for the commercial vehicle side, which is where they got one of the larger orders with, while they have not named it, ever since it's a company called Cummins India. Right now, it's a little bit again turmoil because of this challenge of the tariff and all that. But they believe that once this settles down, this business in 3 years could be bigger than their India business, And it's a company still available at a reasonable valuation. So these are the, and as I said, we started buying the stock in 2018-19, and we kept on increasing the exposure, and it's still part of the portfolio. So it's been like 7 years, and we are hoping to own it for the next 3-4 years.
Thank you,
maybe
sir.
more,
Thank
we
you.
don't know.
Yeah.
Understood. And you look forward to continue to hold it for another 2-3 years. You don't see any challenge.
That's what we see. Now, see, the other thing is that the market sometimes gets very excited, and the stock were to become like 3-4x from here. So one of the things which we are very categorical about is in terms of valuation, both while buying and selling. So if the market were to get very really excited and it starts to discount the next 3-4 years, all the benefits that the company is going to get in terms of valuation, maybe in the next 12 months, we obviously are very open to looking in terms of exiting also,
Understood. Thank you, sir. Thank you for a couple of ideas.
Thank you. Thank you, Gautam. Narayan, you've raised your hand. Do you have a question to ask? Can I move to the question? Yeah, please go ahead, Narayan. You can unmute yourself.
Yes, sir. Hi, sir. Hope you're good. So, as we are doing a bottom-up approach in the portfolio, so can you hear me, sir?
Yes. It's a little feeble, but yeah, I can hear you. Yeah.
Okay, so as we are doing a bottom-up approach, okay, historically, what has been the drawdown when there's a shift in the macroeconomic situation or given the trade wars, what has been the drawdown in the portfolio?
Sure. So what,
one more thing, sir, and also, what can be the drawdown that can be expected, so that if a client is posing a question, this is the drawdown that you can expect, and the bounce will be as such.
Yeah. So obviously, there are 2 types of data that I have, which I would probably like to share with you. One is obviously what is reported with SEBI as per the PMS license, and one, it's a 7 or 8 year audited that we got it done since I've been managing the money. In general, what we have seen is that my benchmark typically I see is the BSE small cap. So our beta, when the market goes down, and not talking on a day-to-day basis, for example, when we are in down cycle, say when there's a 6-8 months or 1-2 year of down cycle and the market's correct between say 15 to 30%, our beta would be in line with the BSE small cap. And typically on the upside, our beta is close to around 1.5, 1.4 to 1.6, I would say, by average of 1.5. That's probably the sort of way you should look at our portfolio. So which means if for the BSE small cap were to correct by 20%, we will correct by 20%. Last downfall, we were a little bit better. So when I think 2020, October 21 to March 23, when the BSE small cap corrected by 25, we corrected only by 16%. We did a little better. And again, on the upcycle, we did more like 1.7, 1.8 when the market recovered in the last 18 months before we again had this type of correction. But typically, you should look at whatever is the drawdown in terms of the BSE small cap is what you will more or less end up getting, maybe 0.9 to 1.1 of that. So if the BSE small cap were to correct by 15%, you should look between 12-13% to 17-18% correction. However, if it were to go up by 15-20%, probably you should expect a 25 to 30% return also.
Thank you, sir.
Yeah. So I'll be very fair with you. For example, the period of post AIF, as we all know, was one of the toughest that we have seen for the small and mid caps. And the BSE small cap corrected from a high of 20,400 to 8,400 on the day of the lockdown, which was a 60% correction in a matter of 2.5 years. And the portfolio also corrected by 60%. I will not give any false promise. That's the way to look at it. But the good part was that beta in the recovery was close to around 2.5. So which is why when the market recovered, so the other thing to look at is that when I look on again my historical data, when the market came back to 20,400, the BSE small cap, which was in between, it was 60% correction, but over the 3-year period, we still doubled our NAV.
Got it, sir. Thank you.
Which is why we keep saying that if you remain with us for 3-4 years, we normally tend to believe that if markets were to not do anything great also, hopefully we'll be able to create an alpha whereby we give you 20-25% return.
Great. Thank you, Sachin Bhai. Before I allow Alkesh, there's a question in the chat box which says that because on the taxation side of it, because here in the category 3, it will be a fund level taxation, and our prerogative is that we want to hold these stocks for long term. So can we communicate to the client about 15-16% blended taxation or a little higher? What would you recommend as a taxation part of it?
So I think, see, with the surcharge and all that, I think blended basis base, one should assume 17-18%, because at least 10-20% you should keep aside where you might book some short term of 20% plus surcharge, right?
So I would like to put one point here is that, see, it is also a function of the markets.
Sure.
For example, if the markets are in a bull market, for example, I think Gautam asked the question on Shada Motors, right? Now, my intention is to own Shada Motors for the next 3 years. But if the market were to go crazy, the stock will become 3x, which happened with few of our stocks that we invested between 21. A lot of stocks which we had intended to hold for 3 years, they all became 3-4x in a matter of, say, 11 to 12 months. I have no option but to book profits, right? Because just for the sheer 3-4-5% and the stock is up 300-400%, I cannot keep on holding that. Now, typically, so in bull market, you will see that the number of stocks probably will be little higher. So maybe your rate will go by 1-2%, because we all know that in that euphoria is when you get a lot of exit opportunities. And sometimes if you're lucky, the way, for example, we can Shakti Pumps, the stock became like 3-4x in a matter of 6 months, right? So we started booking profit there itself because we started to feel that valuations had started becoming a little stretched. Now, if something like that happens, you will end up making up a little higher tax, but normally it will happen when also that year is also very good returns.
Alkesh, thanks, right? Yeah, Alkesh, you can unmute yourself and ask the question now.
Oh, sure. Thank you. Hi, Sachin. So my question is, can you hear me?
Can you be a little loud? Your voice is a little low. That would be better if you can speak a little loudly.
Yeah. Can you hear me now?
Yes, it's more clear now.
Yes. Just wanted to understand your take. See, recently off late, we've seen kind of, big names in the Indian financial market, like Sunil Singhania or probably, Siddharth Bhaiya, all raising their valuation concerns for especially mid caps and small caps, right? Because they have been always juggling into that particular sector. So I'll just quote an example. Essentially, in fact, Sunil Singhania has also started a FlexiCap AIF, right? And then, Siddharth Bhaiya has moved to around 90% in gold and 10% cash, right? Although his 10-year CAGR is still sitting at around 30%, which is insane. So people are raising their concern towards the valuation of the mid cap and small cap stocks in India, right? If you compare it to their global counterparts also, we are sitting at a much higher trailing PE. So what's your take on the forward PE? Is there going to be a correction around, or because of the influx of the mutual fund industry, like 26,000 crores pumped in month on month, the valuation is going to keep growing? Or how do we mitigate this? Because since we'll be entering now, essentially in the mid cap and small cap space, I just want to understand your take.
Sure. So first of all, I have no idea in terms of what the peer group is doing and what their views are. We normally do not spend too much time on that. Yes, your question is regarding valuations. And I think there are two parts of it. One was the valuation you spoke about India, and you mentioned that versus the global peers. So we have to understand the context of valuations. See, valuations are a function of two things. One, I'm talking right now generic and not specific to our portfolio or anybody else's portfolio. In general, what is my view, how one should look valuation in perspective. One is the valuation growth in terms of CAGR, which is the nominal GDP, nominal growth in terms of reported earnings. And second also is the quality of earnings. So I think we have a slide. Raman, if you, I think, can go to the
The
presentation
presentation
here,
where it shows
how India has done. So
vis-a-vis
probably
global.
that will, you know, clear some
Sure.
of the doubts some people have.
Sure. Let me just share that slide.
Yes. I think it's the next years if I get it right. That's one specific slide.
That
we
is
have
first
put it.
slide of the next year. First or second slide. Upar, upar.
I think one more slide.
Upar. Upar jao.
One more slide. I think Raman.
Just 1 second. There was
Yeah.
some technical glitch.
No issues.
This one?
Yeah.
Yes, yes, yes. So if you see, for example, this tells you the return that the because we believe that sometimes the returns could get also you know, clouded by the currency. So this is how we should look at the return in terms since 2000 on a 25 CAGR basis in dollar terms also. So one of the reasons why we have done so well is because our earning growth has been far superior. So even in the market today, for example, if you would see, there are a lot of stocks today which are quoting at say 80p, and look at, for example, the EMS space, right? Dixon Technologies always has quoted between 80p to 140p. Now, in the context, if you would go back 4 or 5 years back, you would say that Dixon is a very expensive stock. Should I buy Dixon? But then it has to be seen as relative growth to that because Dixon's delivered 50, 60, 70% earning growth also. Same is the case with Trent. Trent at one point of time was quoting at 70 TP. From there, also somebody who had made great money because 3 years after that, the company delivered 60, 70% earning growth. So our in general perception is that India in dollar as well as in dollar terms and rupee terms on a nominal basis has delivered far better earning growth in the last 15, 16 years, despite all the challenges that we have seen. Secondly, India is a market where the managements are very conscious about return on investment, and that has become an even larger focus in the last 4 or 5 years. So we also deliver far better return on equity versus some of the other markets. And that is one of the reasons why probably the Indian market stayed at a premium to some of the global indices. Now, within that, obviously, sometimes it will be a little more overvalued, it will be less overvalued, it will remain, but that's the broad thesis on what we think of why the Indian markets trade at a little premium to some of the other markets. Your second question was what happens to maybe if the way we look at it. So as you said that we have been mentioning that we are very bottoms up people. And what I can do in that is that I have to see that I don't end up buying any stock which is at a very at a valuation which is not justified by the characteristic of the business, which is the characteristic of the business, the return on investment or the ROC that they make, as well as the growth orientation that we are seeing. So we look at from that perspective. And as of now, from whatever that we own, we continue to believe that. And maybe if you want the portfolio, I think will be shared on a monthly basis. Anybody has a query on a stock which you think that according to you is little overvalued, you would be very happy and open for you and discuss in detail and explain why we own the stock and why do we think that the stock is not overvalued.
Got it.
Thank you.
But
Thank
one of
you.
the things
Thank you,
that
sir.
we have been mentioning always is that one of the reasons we believe, which is our core to us, is that we are extremely disciplined in terms of looking at valuations. We want to buy companies at very reasonable valuations and not overpay for them. And similarly, we want to be very disciplined in terms of selling it. So it's rather an outcome, and the sector keeps shifting. You keep shifting. So what you do is, when you start finding some stocks, for example, cap goods, right? Cap goods had a fantastic run. Today, we hardly have any stocks in cap goods because we started to feel like there's a fourth in some of them. For example, stocks like Alicon Engineering, Action Construction, are some of the stocks we really picked up early. I would be very also open to admit that, yes, we were a little early to sell, but we made like 3-4x in a matter of 18 to 24 months. After that, stocks went up 40-50% from there also. But today, they are back to the price at which we had sold. So we are very cognizant of the valuation of the stocks. Normally don't overpay, but yes, sometimes there could be, for example, I tell you, I'll be very open. There are stocks that we own, which are export oriented in nature, which we had discussed about one of the previous queries, where right now there is a challenge in terms of performance because earnings have taken a hit, and that is rightly so because nobody at 50% tariff and not knowing what to happen. There is a cloudness on what the things will be the next couple of quarters. And yes, and this stocks has not done well. But it's not that we did not sell those stocks because they were very high valuation. The entire paradigm change, which you and I, nobody knew about, right? So that's a very different thing altogether. But very rarely will you find stocks probably which will have very high P. I think as of now, the highest P stock that we have in a portfolio is something like a V2 retail, which is also one of our largest position. But we continue to believe that they are again like on trend on a very high growth trajectory. And this year also we are looking at a 40-50% earning growth. Next 2 years we are looking at almost 35 to 40% earning growth. So we believe that when you have 35 to 45% earning growth for the next 2 or 3 years, then maybe you can justify some of these high valuations.
Yeah, maybe
Yes.
Thank you so much. Thank you so much.
Thank you, Sachin. Thank you, Alkesh. Jigar Bhai, there's a question, maybe you can answer. It says, from the listed allocation perspective, you mentioned that this strategy is a replica of the Velocity PMS. Could you please clarify if there are any minimum or maximum limits defined for allocation within the listed strategy, one, or is it structured as an open-ended approach that continuously chases return without defined allocation boundaries? So
No, but typically we cannot do more than 25% in unlisted or whatever in Cat 3, and that is what we'll maintain. So I'm not saying that 20%, 25% up to 25% we will do it. We may go up to 25%. Baki to listed hi rahega.
But I'll be very honest, as of now, unlisted to begin with I don't see more than,
More than
5,
7,
5 to
8%.
10% in the next 12 months, unless sometimes we find something which is very, very attractive, which we think can, for example, the way we did Vikram Sola last year, where we could very clearly see it becoming a 3 to 4x in a matter of 12 months. ऐसा कुछ juicy opportunity मिल गया तो थोड़ा जाएंगे, बाकी 5 से 10% is what as of now the mandate is, and as when we said that 2025, that's the mandate as per the SEBI, I think allowed this one,
which we may use. I'm not saying we will use it, we may use it. आप समझ के चलो anywhere between 15 to 20% on a running basis, पूरा unlisted, preferential and pre-IPO मिला के, और उसमें unlisted
preferential is again listed only.
हाँ, वही listed ही है.
हाँ, listed नहीं listed.
But that's a 6%.
No. Question specific to unlisted ना.
So not
unlisted, my thing is you should look at 5 to 10. And कभी कोई बहुत अच्छा opportunity आ गया तो maybe 15. That's it.
Fair. Thank you. And there's one more question which from Swapnil says there is one pager was CWD Limited, whether it is part of your portfolio and it's just SME company. Are we willing to take such small cap investment? Is a question one of the teams asked.
So that CWD was a case study we have presented, tried to explain that what we have done in our personal capacity along with some clients as a co-investor on the unlisted or a preferential basis. There are some case study we have tried to demonstrate that what we have done in that segment.
So specifically, as I mentioned, that our view is that when we are looking at such small companies, we would tend to look them with from a 5-year perspective. So we are very clear that CWD is something we are invested from a 5-year perspective, and a small allocation is what we are. It's not going to be like a 5-6% of the portfolio. Yes, but if we get such a good opportunities, we are happy to look at between 1 to 2% of the portfolio allocation to such small cap companies. But this will not be normally from the market. This will only, again, CWD is something we participated because it was an illiquid stock and there was no point going and buying from the market. So we got an opportunity to invest in the company via preferential allotment route. We did exercise that option. It could not be done via the PMS because PMS doesn't allow us to do preferential. So what we did is we put our own capital, and to our select clients, we reached out that there's an opportunity to invest in here. And few of the clients who were interested, they did participate along with us. And that's how I think of the total fundraise of around 100 crores, around 60 to 70 crores was committed by us and our set of clients.
Great. Perfect. I think that comes to an end for the Q&A part of it. I request Sachin Bhai, Jigar Bhai, if you can just put your last thoughts and summarize, and then we can close the call.
So it's we are available for any kind of queries, client connect, or any kind of response you need from our end. So Kanishk and team are available, the kind of things you should be doing to reach out to us. So we are happy to reach out. We are happy to connect with the clients. So that is one. And secondly, we think that after this last year of consolidation where market has not given any kind of return, probably you cannot keep market at current level for longer period of time. So don't keep on waiting for a correction. There is no right time, but we think we are getting to that right time zone. So please take that opportunity and reach out to your clients and see if you can do some kind of garnering.
Fair. Great. So thank you, Jigar Bhai. Thank you, Sachin Bhai, for taking the time out and taking us through the strategy. Team, I hope you got most of the questions cleared for yourself. That the team is available for client meetings. You can reach out to Kanish, if you need any support in setting up those meetings. The presentation is available on NLA. You can download the presentation from there if you need any support. your CXO teams, Anil's and a team is available for an onboarding perspective. You can reach out to your CXOs and they'll be able to support you in getting the onboarding complete. Thank you very much. We look forward to connecting you soon again for an update where we are. And till that time, all the very best to everyone and have a great day.
And
Thanks.
thank you, Raman, for
Very
coordinating and scheduling this call. And thank you, the entire Novama team, for taking the time out and doing this call with us. We look forward to an active and healthy engagement and participation on a long-term basis.
And prosperous participation for both of us.
Yes,
Yeah. And
absolutely.
including
Look
clients.
forward. Absolutely. Looking forward.
Thank you.
Thank you.
Vasant.
Thank you, everyone. Take care.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.